It's Mike Belfor, American Pacific Mortgage. I figured this may be incredibly helpful just to share a few things about, of course, our company and myself, if that's okay, and just kind of show some key benefits and really kind of provide a guide to financing, if you will, in regards to things that we're doing here that may be of interest. So I'm going to share my screen so you can kind of see this. And so this is kind of, as we call it, the Realtor's Guide to Financing. Now, just again, want to say, welcome, to this presentation, and thank you so much for taking the time to check it out. So a little bit about myself. I've been doing this for 20 years, starting in 2003 in San Diego. I've been with American Pacific Mortgage now for about 13, and received my formal education, both my bachelor's and master's from Liberty University. Year over year, I've been ranked within the top 1% of mortgage originators in the nation. Funded $1 billion in total loan volume throughout my career. Had notable positions held as far as chairs go within the Rent Association of Realtors, Government Affairs Committee, NAR rep, and then, of course, the Young Professionals Network as well. Our company has been ranked as a top military lender. We've been ranked as the #1 FHA lender in California, the top HFA lender, and a lot of great things, our company as well. So, one thing we like to say is we like to bring people home. So we're a top 10 independent mortgage banker, and we're known for creating experiences that matter. We serve our communities, referral partners, and buyers with a personal touch and, of course, attention to detail. As you know, I like to follow up, and I'd like to continue to follow up. And when we have an active buyer, calling them every Monday to check in, if you need anything, and you find options, or would you like me to work something up for you? It's always kind of the thing we do, and of course, giving them updated market data as well, so they know exactly what's happening in our ever-changing real estate market. So, as far as online, we have quite a few 5-star reviews. I myself, 5-star reviews, several hundred throughout Yelp, Zillow, Facebook, Google, and our company, of course, quite a bit more than that. We have over 400 branches in 49 states, and then we have quite a few loan programs that are offered as well. So our core values, of course, respect, transparency, and we're scrappy. As we say, unwavering resolve. We'll find ways to get things done that they can be done. So our agenda is really just to kind of go over who we are, what we do, credit, collateral, capacity, the loan process, pre-approval, loan progress, and then, of course, focusing on the fact that you are the VIP. So qualifying for a mortgage, of course, credit we look at, is there a solid history of repaying debt? Collateral, does the seller's price meet the required value of the property, and was the property condition in? Capacity, could the mortgage be repaid? So how FICO scores are calculated, all right? So 35% is what we look at for payment history. Essentially, what the lender wants to know is whether you paid accounts on time. This helps the lender figure out the risk it would take when extending credit. This is the most important factor in a FICO score. 30% amount owed, having higher credit accounts, owing more money on them, does not necessarily mean you're a higher score. With low FICO, however, if you're using a lot of your available credit, this may indicate that you're overextended, and banks can interpret this to mean that you're at a higher risk of defaulting. So, we also look at 15% of this core here, if you will. In general, longer credit history will increase FICO scores. However, people who haven't been using credit for long may have high credit scores depending on how the rest of their credit looks, right? So a few things to take a look to count here is how long your credit accounts have been established, how long specific credit accounts have been established, and how long it's been since you used certain accounts. Now, there is 20% in use in new credit. Credit mix is 10%. New credit is 10% of that. And that kind of gives you your full amount of how credit scores are generally calculated between the credit agencies. Now, qualifying after a credit event. Here's just a chart of what's required. Feel free to take a screenshot, or if you want me to send this to you, I certainly can. Just shoot me a message. But for a conventional loan, often jumbo as well, foreclosure 7 years, short sale 4 years, Chapter 7, 4 years, Chapter 13 is 2 years. Now, FHA and VA are shorter. 2 years pretty much across the board for a VA, 3 years for closure, pardon, and short sale, then 2 years for a Chapter 7, 1 year for a Chapter 13. So there are still options for low score buyers. Now, FHA has a minimum 580 credit score. VA 580, USDA 640 conforming, home ready, home possible, between 620 to 660, non-qualified mortgage 640. Now keep in mind, FHA, VA, there are some products out there we could broker to that in some cases could go as low as a 550 credit score, depending on the circumstances and other compensating factors. The next item, of course, is collateral. So this is looking at appraisal. So as we look at appraisal, the appraiser generally should be equal or greater to the purchase price. Now, if it's not, and it is less than that appraised value, we would essentially use the lesser of the amount to start our margins, if you will. So let's say you're buying your property, simple figures, for $1 million, you're putting 20% down, $800,000 purchase. That property appraises for $950,000. That would mean that we're going to use $950,000 and then of course 20% thereafter. Now, of course, they likely could still get an $800,000 loan and still pay more for the property. However, that would require mortgage insurance, and it would be less than a 20% margin of that property itself. Now, the property must be in good condition unless purchased as a renovation. We do have some renovation loans available. And certain loans require specific condition of the property, like VA loans. Mechanical systems are usable and safe, adequate heating, safe water supply and sewer, adequate roofing, basements, crawl spaces are dry, clear of debris, properly vented, and safe access from the street. Of course, there's more than that as well. FHA, similar, really similar to the VA program, right? And I do have an FHA appraisal checklist I could send out. I think I may have already sent that to you. If not, let me know. I can certainly send you a copy of that. Again, just shoot me a message and be happy. So appraised value versus purchase price. Of course, the appraised value is the estimated value of the home determined by a third-party professional. Purchase price is the cost the buyer will pay for the property. Loan amounts can only cover up to the appraised value. Anything above that value will need to be paid out of pocket. So understanding loan to value. The loan to value ratio is used as a risk assessment tool for lenders. The higher the down payment, the lower the loan to value. Typically, high loan to value ratios are considered what we call higher risk loans. Higher risk loans have slightly higher interest rate and mortgage insurance, and the lowest interest rates usually come from those are 80% loan to value or lower. In fact, if you could do 25% or 75% loan to value, it's much greater than that. Down payment. Down payment is the amount of cash put towards the purchase of property. Minimum down payment usually range from 3% to 20% of the home's purchase price. And there are, of course, loan products with low down payments, such as conventional loan, as low as 3%. Down payment assistance or state housing, as you may have heard, Cal HFA, we're well regarded as a Cal HFA lender. We're actually ranked as the #1 Cal HFA lender. You could get 100% financing. Even at times, some credits towards closing costs. FHA loan is 3.5%. Jumbo loan, 10 to 20%. Specialty products like non-qualified mortgage, 5 to 20%. USDA and VA, 100% financing available on those. So capacity is the third C that we look at, and that's questioning if the mortgage could be repaid. Qualifying for a loan, a couple things that we look at. We're going to look to verify funds for down payment, closing costs, and required reserves depending on the program. Now, acceptable source of funds would be checking, savings, stocks, mutual funds, 401k loans, gifts, and gifts, of course, are allowed when the program selected is allowing it. It's usually for a primary residence, and it has to be from a family member. Big thing that we have is, of course, we must show paper trail. For any large deposits really going into accounts, we want to make sure that we paper trail those amounts. There's a report we have to fill out if a file is ever audited, and we just have to paper trail these things. And it's due to FinCEN, SARS, which I know escrow companies complete as well. Now, income and employment requirements. Generally speaking, tiers of employment is required. It's the same line of work as the preference. Schooling may count actually as a job history. And then if you're using any sort of bonus income, commission, or overtime, we must have a tier history. It could be between jobs, but it has to show that it's consistent, has been received for at least 24 months. And then, of course, job gaps may be okay, right? If you leave one position, go to the next, depending on how long that gap was, may be able to use it. Now, of course, self-employment, we need 2 years filed tax returns. In some cases, we can get away with one depending on the loan program itself. And then, of course, for investment or retirement properties, we would need qualifying investment retirement accounts that would basically show that they're able to continue to make those payments 3 years past their mortgage application. And in a lot of cases, we can only use 70% of investments, especially if it's stock sponsor security. Of course, other items that we take into consideration would be 401k or retirement statements, and of course, child support, alimony, things of that sort. So this is just a breakdown on how debt to income ratios are calculated. Of course, if we look at Mr. and Mrs. Smith right here, their income is roughly $7,500 a month. They have a car payment of $500. If they're buying a property for $350,000 and putting down 5%, that loan amount is $332. If we're using an interest rate of 4.25%, that would give you this principal and interest payment. And then, of course, if you see that chart there, taxes, property taxes is what that T is. I is insurance, you have mortgage insurance below that, and then you have PITI, which is the total amount. That total amount for the front end is 28.7. That's what we call front end debt to income ratio, right? Or the housing expense ratio. Now you have a car payment, as we mentioned, for $500 a month. So when we take a look at it, we're going to calculate that in the back end debt to income ratio, which is a total housing ratio or total expense, if you will. We're going to look at for qualifying a buyer in that case. So are a few steps in completing a loan, and we're going to go through, those steps to pre-approval versus pre-qualification, and of course, loan products thereafter. So we start here, right? It starts with the application, and that's where we basically would get somebody pre-approved, and then of course we get permission to run credit. Lately, we've just been doing soft credit checks, and we've been able to pre-approve somebody in that. The next step, of course, is finding a home. What we like to do is work up scenarios to go over, number one, what the buyer's qualified for, and of course, what they want to spend, what fits their budget, lifestyle. Go over that, and then we'll send that to you. And when you find a property and you want to get a pre-approval letter, we like to send a pre-approval letter that actually matches that property specifically, so you know exactly what it looks like. And the seller does, and listing agent as well. We'll call the listing agent to talk to them and basically really talk about how awesome and amazing our team is and how fantastic the buyer is. After that offer gets accepted, initial disclosures will be sent out to the buyer. And then, of course, we'll start processing the home loan, which is where we basically ask the buyer to start shopping around for insurance, homeowners insurance policies. And then, of course, we'll order those appraisals at the same time, and inspections are then ordered. The file then goes to underwriting, initial underwriting approval. And just if I can stop right there for a second, often we'll get a file underwritten before you even make that offer. So you could write a non-contingent 12 or 14-day close, which we're known for doing quite often. After the underwriting, of course, we get final approval, and initial closing disclosure will then go out. And then we sign, close, and fund the transaction. And in most of our cases, we close our transactions, as I mentioned, within 14 days. If we could get them fully underwritten, there are cases where we could get them closed within 10 to 12 days as well. Loan documents are sent to escrow, and then we basically wrap up this transaction thereafter for you. Celebrate, high five, and congratulate a buyer on their new home. And that's where the excitement is, right? Approval versus pre-qualification. Talk about, basically qualifying. Qualification is the best estimate by loan officer, basically myself and my team. And the property can be what we call TBD, meaning there's no property identified. And usually we could get a pre-qualification same day. And if there's time to, even within an hour of an application. So it doesn't really help to offer or make negotiations thereafter, because we don't have anything other than just an application and a soft credit check, if you will, to see what those ratios look like. Now, of course, the pre-approval is where we get fully underwritten. The property can, of course, still be TBD. And then that way you can make that stronger offer, because we looked at income, asset, all those documents, and that it helps us to get somebody set up with that. Now, there's, of course, a program that we have called Secure Lock. So in this case, we could actually lock the loan before they even enter into escrow once they're pre-approved or even fully approved thereafter. So we have our keys on time guarantee, which essentially would pay $2,000 in closing costs to the buyer or seller. If we don't close on time, we definitely put our money where our mouth is. So, in order to do this, we want to make sure that we also have responsive parties. And if we somehow drop the ball and there's a delay due to us, we'll pay $2,000. We'll own it, essentially, which, we haven't had to do yet, knock on wood. But something that I think is pretty awesome, and saying, hey, we're going to close in 12 or 14 days. If we don't, we're going to pay for it. That's something that we hold as really important to us, is making sure that everything closes swiftly, efficiently, effectively, and on time. So let's talk about loan products. So we look at loan products, we have conventional loans. Now, of course, this is gated for, loan amounts are higher now. $1,089,000 is the current amount that we have. Programs still allow for as low as 3% down, single family condos, PUDs, and now there's guidelines for house hacking. You put as little 5% down as a multi-unit, which would allow for much larger and expanded loan limits. And of course, allowing the buyer to use what we call house hacking, qualifying for the purchase using the income of the adjacent units of the property itself. So we have government sponsored loans. Again, FHA, we're ranked #1 in California. VA, we're a top VA home loan lender. We do USDA loans as well. And then of course, we have the ability to do jumbo loans in-house up to $5 million. We have first-time homebuyer programs, a wide array of programs, and that's available to those who haven't owned property within the last 3 years. And then, of course, we have fixed rate and adjust rate programs. Now, fixed rate, of course, the payment never changes. Rate is usually higher than the ARM's start rate. Is a more conservative option. And then, of course, adjustable rate, you have a fixed rate for 5, 7, even 10 years, and then adjust thereafter. And then it would be adjusting throughout the rest of the term of the mortgage itself. So FHA is a government insured loan program. You don't have to be a first-time homebuyer. It requires 3.5% down payment. There are rehab loans available. Gift funds are allowed, and no cash reserves are there. Now, minimum credit score is 620 is required for 3.5% down. However, we have programs that go all the way down to, as mentioned, 580, and we can broker down to a 550 credit score as well. Home loans, again, 100% financing is for the military, veteran, and spouse only. You don't have to be a first-time homebuyer. The great thing about this, there's no mortgage insurance. USDA 100% financing, don't have to be first-time homebuyer. Property must be in certain rural areas. 100% gift is allowed. Minimum credit score for USDA is 640, and there are income limits on this program as well. Loan programs, we have self-employed loans, we have no ratio loans, bank statement loans, ITIN loans, investor loans, DSCR loans, which is great for investment properties, right? Construction loans. So we have in-house construction loans and easy builder approvals and smooth draw process, renovation loans, bridge loans, and reverse mortgage loans as well. So the 2-1 buy down the last couple of years has been super duper popular. This kind of just gives a rough estimate of what that looks like. I actually have a full presentation on this, but essentially, let's say you have a rate at 7.5%. That first year is 6.5, or 5.5, then it goes to 6.5, then 7.5. I have a presentation on this again, so if you'd like that, let me know. I can definitely send that to you. So there are also cash buy loans, which allows you to actually have delayed financing on a property, where you could actually have the cash available to make a cash offer on a property, and then waiving financing and appraisal contingencies will work to secure the financing before closing. And if the financing isn't ready, cash buys is ready to go, and the property will be purchased and resold to the client at the same price. So as I mentioned at the start of this, you're a VIP to us. So we have co-branded marketing material. We have listing flyers. We can create websites for your listings. We can create postcards, co-branded customizable mobile app to share with your clients that they can apply on. We have financing option flyers. We have a lead capture for you for every open house that you have. We are huge on nurturing the follow-up leads as well. So the customer will get sent back to you in time, even if it's almost, I'm a year out, or I want to work on my credit. We can do credit improvement coaching for them and send them back to you. Night and weekend, we're always available. And we definitely are huge on communication with both the buying agent and, if you're okay with it, based on the transaction, the listing agent and selling agent as well. Questions on any of this stuff, of course, feel free to reach out to me. I'm always here, always want to help with anything that we can do. So feel free to call, text, email. And again, thank you so much for joining me and going through this presentation.